Welcome to another edition of your on-air series for the City Business Festival 2025, brought to you by Absa Bank, also sponsored by MTN and Zonda Technologies. We're still talking personal finance. Today we're looking at investment basics. My guest is the president of CFA Ghana. What is CFA? Chartered Financial Analysts. They are the high level of finance gurus. Nana Uyafe-Boama. He'll be helping us understand what are investments, what are the various asset classes, and how do you leverage those to create wealth. Stay with us. Welcome back. So my guest for today's edition is Nana Uyafe-Boama, who's the president of the CFA Society in Ghana, and he'll be helping us think through investment basics. Nana, welcome to the program.
Thank you very much, Bernard.
Wonderful. So CFA Society is a society of chartered, is it finance or financial analysts?
Chartered Financial Analysts.
So that's it's like a professional.
Yes, for those aspiring a career in investment management, basically,
Okay.
yeah.
So that means like you have chartered bankers and chartered finance people.
Yes, sir.
Wow.
Yeah.
Somebody said finance is the lifeblood of an economy, and that if we crack finance, we can develop. Do you agree?
I do agree. Without finance, we can't build our roads, we can't build our hospitals, we can't build our schools. So everything revolves around getting
The right
basics.
finance.
Yeah, I mean, right. And that's finance, yeah.
Interesting. The other thing I think about as somebody who studied economics is that of the 4 factors of production, land, labor, capital, and enterprise, I think our problem in the developing world is capital. Because we have a lot of land, we have people who are reasonably well educated, we are very enterprising people. It appears to me that the financing to unlock our economies seems to be the issue. Is that correct?
I agree, Bernard. I agree, Bernard. US is US because, I mean, they've built a very well-functioning capital, market. So without, getting the finance right, without getting investing right, you can't really develop. So capital is absolutely crucial.
And in this, I use capital and finance interchangeably. The last point, I was talking to somebody this week about savings, and the person said, if you can't save when you have low income, don't expect to save when your income increases. Second thing they said was, if you don't develop a savings habit, you cannot invest. So in a sense, savings is what builds the muscle for investment. Are those 2 statements correct?
Correct. I mean, the best personal finance book I've read is Psychology of Money by Morgan Housel. And he says, savings is the difference between how much you earn and your ego, right? So
Wow.
in the book, he cites an example of a secretary. She worked as a secretary for all her life, died and left behind over $5 million in assets to his favorite charity. In the same vein, there was this guy who was a top banker from Merrill Lynch, schooled at Harvard. The same year, Grace, died. Grace was a secretary. He declared bankrupt after earning millions upon millions of dollars. So
savings is the difference between how much you earn and your ego.
And your ego.
I.e., if you want to spend it to keep up with the Joneses, you can't do much.
You'll be broke.
Amazing.
Yeah.
So when we say investment, what are we talking about?
So investment is basically deploying that saving into an asset that can generate either cash flow, i.e. income, or grow in value. So that is basically investment, purchasing an asset that generates income or an asset, that grows in value over time.
That's quite interesting way of putting it. So then, let's talk about what we call asset classes, because you're saying an investment generates cash flow or grows in income, it grows in value, which eventually can also bring more cash.
Yes.
So what are the various things that a person or an institution can invest in? Walk us through.
So broadly, there are 2 main category of asset classes: fixed income, right, and equities.
Okay.
Right. Those are traditional asset classes. Fixed income is any asset that generates fixed income. So when you buy government bond, you are entitled to a fixed income, and that fixed income is the coupon, not fixed return, fixed income. if you put money in a bank fixed deposit, the bank promises you a certain percentage of income. So those are examples of fixed income investment. If you buy a corporate bond, right, you are entitled to a certain level of fixed, income. So all those investments are categorized as fixed income investment: government bond, fixed deposit, corporate bond, etc. And then we have, equities. Equities, basically is buying a stake in a company. And usually when we talk about equities, we are talking about buying a stake in a listed, company. So on our Ghana Stock Exchange, there are quite a number of companies. You can buy a stake in any of those companies. If you buy equities, you are entitled, to dividends if the company so declares dividend upon a good performance. And you are also entitled to capital gains or capital loss. A cut, both ways. If the company, does well and investors demand that shares, prices will go up, and vice versa. If you purchase fixed deposit, like I said, you are entitled to fixed income. There is also, capital gain, capital loss. 3 years ago, mark-to-market became a topic in vogue because bond prices, generally fell because of higher interest rates. So you bought a bond for 100,000 at 18% coupon. Suddenly, interest rate is now 25%. You want your bond before maturity. If you go onto the market to sell, you would realize a loss. So that is the capital gain, capital loss with fixed income if you want your money before maturity. However, if you be patient enough to wait and get your money at maturity, you buy a 5-year bond, you wait 5 years' time, the money matures, then you get your principal.
I'll let you elaborate on that when we come to what a haircut means.
Absolutely.
But let me summarize what I've heard so far. There are two general kinds of investment: fixed income and equity. Fixed income could be a government bond, fixed deposit, or corporate bond. And a bond is basically an instrument that somebody sells to you that you buy with the hope that you will be given a particular interest rate, which is called the coupon.
Yes.
Now, equity, you've discussed public equity, which is listed equity. So a company wants to raise money, like MTN, and they sell a share at a particular price. And you're saying, I can gain two things from there. If they declare profit at the end of the year, they pay dividend to shareholders. Or if the share price increases, I can get capital gains. If I'm lucky and they do both in the same year, I'm smiling. Where does private equity fit into this conversation?
So private equity, commodities fall under a category we call alternative investments.
Wonderful.
Right, so if you are interested in business, you want to put your capital into your own business, I see that as private equity or private investment. Right, if you feel, because of Donald Trump's trade antics, the world is a bit unsafe, and you want a safe haven asset like gold to invest in, that becomes a sort of alternative investment. So anything outside of the fixed income category and the equity category, public equity category, falls under alternative.
Okay.
Right? And
so when we talk of alternative and in terms of like private equity, so private equity could mean maybe somebody has a company and he's looking to set it up and he needs money. I could either lend him money, which is debt, or I could say, I'm giving you 2 million CDs for 2% of the company. That's private equity, but this is not a listed company.
Absolutely.
So we come up with an arrangement as to how, as the company grows, I will benefit from that investment. So that's private equity.
Yeah, but because of the complexities in that particular form of investment, you would want to, give that 2 million to a fund manager that specializes in investing.
That type of thing.
Exactly.
So that depending on what the company gets, we can know how I grow.
Exactly.
Because the company may go and raise more money, and then my 2 million, which used to be 20%, can become 5%. So I need to understand those dynamics before I do that type of thing.
Exactly, and there are specialists, fund managers that specializes in investing in private equity, because the due diligence it takes, to invest in opaque private company is difficult, right? And once the investment, goes into those companies, you don't sit passively. You are probably actively involved in ensuring there's value for your money. So if you're an individual and you were doing it yourself, you'd want a board seat, dictate policies, so that your money, your 2 million, doesn't go down the drain.
Okay.
It is difficult, for an individual, to do. Right? You can do it, but then it's quite, difficult. However, there are private equity funds that specializes in raising, capital from high net worth individuals who have 2 million to invest, from institutional investors like pension funds that have $5 million. They pool all this capital, go out there, do the hard work, identify companies that are credit or equity worthy, invest in those companies, and then actively monitor those investments to ensure.
So private equity firms play a role of matching demand with supply.
Absolutely.
Critical for an economy.
Absolutely.
Young businesses needing money, private equity firms can help you get ready for the money. Wealthy funds, whether sovereign or not, looking for investment-worthy vehicles. So PE firms play that very important role.
They do.
All right. Now, I've heard other things like commodities, currency, real estate. Where do they fall in your general description of asset classes?
So all alternatives.
They are also alternatives.
All alternatives. All alternatives. So yes, real estate falls under alternative. And real estate, basically, I guess, is the biggest asset class, right, on planet Earth, right? So real estate, is there, but then again, like I said, it takes active management.
Yeah.
You need to be.
We'll do a series on real estate later.
Yeah.
What about commodities and then currency?
Yeah, gold, diamond, platinum, they are all alternatives, right? You need to understand the cycles to be able to invest in those assets and make money. But they all fall under alternative asset class. So the category under alternative is broad. That's why I said anything outside of the traditional fixed income and traditional public equity investment can be categorized as alternatives.
A lot of my listeners would say that they buy T-bills, which is shorter term. Where would they be? Is T-bills fixed income? Simpliciter?
Fixed income. Fixed income.
Because it is on the shorter term end of the fixed income stick.
Exactly. So when it comes to, the fixed income category, we have various maturities, short term, long term, and medium term. So treasury bill will fall under the short term, category. So
in investment, what is short term? What is medium term? What is long term? Is it accepted globally, or it depends on where you are in the world?
Yeah, I think accepted. Yeah, it's basic. So in Ghana, I classify, anything below 1 year as short term, anything between 1 year to 5 years as medium term, and then 5 years above, long term.
So T-bills are definitely short term.
Definitely short term.
This is a preamble I've used throughout the week. People say when investors prefer the short end of the investment stick, it suggests a certain lack of confidence. That the more confidence goes in the economy, the more long term their horizon. Is that correct?
So maybe for the institutional, big money guys, yes. But then for personal, finance, I think your decision should be something you do that would make you sleep well at night.
Correct.
Right? I keep saying when it comes to investment, it's not really about the returns you're making, but then the time period. How committed are you to invest over a long period of time? That's where the gains are from. So institutional investors, banks, that buy investments, can make certain investment decisions based on their outlook on the economy. But for an individual who is trying to accumulate wealth, it is what will make you, sleep well at night. If given your money to the government, for 2 years, will cost you sleepless nights because you're unsure what will happen in 2 years, just do 91 days and keep rolling it over, right? If committing 1 year capital to a bank in a fixed deposit would give you, some, heartburns when you hear, certain news, just do your 91 days and roll it over. So yes, investment maturity decision by investors kind of informs on the outlook of the economy. But for an individual,
it depends on your circumstance.
Depends on the circumstance.
We'll pause there and come back. This is the on-air series of the City Business Festival 2025, brought to you by Absa Bank, MTN, and Zonda Tech. When we come back, we'll continue discussion on investment basics and try and understand some of the dynamics of the 2022 debt exchange and what it means for your investment decisions going forward. Stay with us.
She's coming. She's coming!
Oh, it's in. Red out receipt now!
Boss, let's go back.
Okay, here. Take this.
She's
go to
coming.
I know. Go to the pharmacy now.
She's coming! Oh, she's here.
Pay faster, pay safer, and pay easy with Momo app. Download now and pay with the QR code, merchant ID, and so much more.
Welcome back to the on-air series of the City Business Festival, which is on ChannelOne television and on 97.3 CFA. My name is Bernard Avle. This is our third in the series for the week where we are looking at investment basics. My guest, Nana Uyafebuama, who is the president of the CFA Society in Ghana, an investment financial consultant and expert who has been breaking things down for us this morning. Now we know there's fixed income and there's equity, and he's given us various diagrams in our heads. Now, I just wanted to come back to something. So clearly, bills are the short end of the bond market,
Yes.
and then there's fixed income and there's equity, which you explained really nicely. You were explaining mark to market when before we went on off air. So in 2022, after the financial challenges, there was a big announcement that the government was now going to mark people's investments to market. A lot of people were quite upset. What was the alternative to market? What was happening before that? And what does it mean to mark something to market? So you gave a 100 CD example. I buy a 5-year bond, 100 CDs, 18% coupon rate, expecting that if I keep the money there after 5 years, I'll get both the principal and the 18%. What does mark to market mean, and why was it so controversial at the time?
Mark to market. Well, thanks for the question. So every investment out there has potential reward, that is the return, and risk. So when you buy an equity in a company listed on the Ghana Stock Exchange, your share price could go up, it could come down, right? I mean, we created the impression in Ghana that fixed income investment is riskless. So when you buy the government bond that is promising a 20% coupon, a 5-year bond, right? You get your coupon every year until maturity. At maturity, you get your money back. Now, the risk with this kind of investment is you may have bought your bond at 20%, but interest rate within the economy goes up and down, right? When interest rate, goes, down, value of investment goes up. So you buy your 5-year bond, 100,000, CDs, 5-year maturity this year. Next year, interest rate, comes down to 15%. If you decide, to sell your bond, right, you would sell your bond at a higher price because interest rate is 15%. Government will issue new bond at 15%, which will make your 20% bond in high demand. So there'll be more demand to get your 20% bond. And when demand outstrips supply, prices goes up. So that becomes capital gain.
For you, the person
who is
the bond.
selling
Yes.
before maturity.
Wonderful.
Vice versa, if you buy at 20% and suddenly interest rate in the economy is 30%, and government is issuing new bonds at that 30% interest rate, what happens to your bond? Investors would want to demand that 30% bond that is newly, issued.
So your 20% is not attractive.
Attractive. So people would dump. Holders of that 20% bond would dump, sell your bond to realize cash and go and chase the 30% bond. So that is the basic explanation of mark-to-market. When interest rate fluctuates in an economy, the value of bonds and fixed income securities also fluctuate. You are only promised your principal if you are holding to maturity, right? If the bond matures in 5 years' time, irrespective of what happens to interest rate, you get your bond. So really what happened in 2022 was most of the outstanding bonds in the market were sold at 17, 18, 19%. And suddenly, the country was confronted with economic crisis, and interest rate, suddenly, moved above, 25. Now, what happens was smart investors who had mutual funds and had monies in collective investment scheme saw their returns on those mutual fund investments, probably, 18, 19%, compared it with the returns on treasury, bill and treasury, bonds, 25, 26%. And they thought they could, dump their mutual fund and go and buy, treasuries. So we saw quite a number of outflows from mutual funds. At the time, mutual funds were not marking to market. So really, mutual funds, were accumulating losses because they were making, their investors, whole. They go onto the market, to sell because there weren't much liquidity coming in. They sell at a discount, yet still, pay.
So they were making massive losses.
They were making massive losses. And we thought, or I thought from a professional standpoint, the only way to stem that tide of investors really gaming the system, there was a clear arbitrage, was to introduce mark-to-market. So if you want your money, fine, you can get your money. But then we are going to sell at the market and whatever value we get.
So it means that common sense should have told us to lock in mark-to-market from the beginning.
From the
so
beginning.
It looked like the investment schemes overpromised.
Absolutely.
Thinking that things would be stable. And when instability came in, they had to now change the rules. So that's what led people to lose confidence in the collective investment schemes.
That's what happened.
Which people still say that the schemes are paying for. Because it looks like a lot of people's trust in those types of investments went down because they were not fully told the fine print.
Absolutely.
So that's what went
Absolutely.
on.
And genuinely too, there were people who really needed money for very, good reasons and suffered, the consequence. There were some that barely, saw a clear arbitrage opportunity. So I agree. We should have marked to market the value of all securities, fixed income, right from the word go, right? And I keep saying, on the professional side, if we were doing that, you asked the question, we would have seen the crisis, coming, and probably rebalance our portfolio, sold our long-term holdings, and invest in short-term. Because once you hold a fixed income security that have a short time to maturity, the impact of interest rate changes does not hit you that much.
Quick question. Because not everybody understands these things, collective investment schemes are portrayed as a vehicle that can help you because they pool resources and they use their expertise to diversify. Are they still feasible? What's the better one? A viable option for people who want to climb up the investment ladder, collective investment schemes?
They are absolutely. They are. For non-professionals, you don't have much options, right? So I think collective investment schemes are a viable option. And to be, blunt, there were some individuals who had money in collective investment schemes complain about the mark-to-market. Those same individuals, held bonds with government from various financial institutions. And they saw, the significant loss from their direct holding. and didn't.
And yet they were expecting the collective investment schemes not to do the same.
Exactly.
So they were taking haircuts for the individual bonds, but hoping that, because I think they felt that the collective investment scheme was the hedge, because they believe that a collective scheme has more people and they have more expertise in managing. So they were hoping to get more from there. So I don't know. Whatever.
Yeah, I mean, it was the black swan. I mean, you can't really, yet still, I think, I mean, most, I mean, of the collective investment scheme, I mean, they've stayed, I mean, true to the course. I mean, they've provided, I mean, liquidity, albeit, I mean, not to the level of the client expectation.
Okay.
So the credible, well-managed collective investment scheme came true for their clients.
Yeah.
They were obviously, I mean, bad nuts who, I mean, took, I mean, money and invested in something else. I mean, those.
Yeah. Final point. A lot of people, because of the crisis and the haircuts, have become skeptical about anything, whether it's a government bond. Some people think that's good because they would look at equities more, and they would also look at other classes. Now, two things. We're told that the economy is revamping and confidence is going up. What's your general comment about what this renewed confidence in the economy should mean for people's investment decisions?
No, I think the lessons, I mean, out there, Bernard, is diversification. Right? Diversification, we say, is a free lunch. So do not put all your eggs in one basket. If you had diversified, I mean, well, prior to 2022, I don't think, I mean, you would have taken those mark-to-market losses on your mutual funds or on your direct investment in government bond. You may probably have resorted to other investments that you have to meet your liquidity needs. So, I mean, the lessons from everything we've gone through as an industry, as an economy, is diversification, right? And those, I mean, who, I mean, fails, I mean, because of what they've gone through, they won't invest. I like using this analogy. I mean, if you get, I mean, a stomach bug because you ate a bad food, will you say, I mean, I won't eat, I mean, again? I think investing is part of us. I mean, as long as the earth remains, you know, seed time and harvest. So, yes, sorry, I mean, you've been affected because of everything we've gone through, but you can't sit on the fence.
So let's learn from the mistakes.
Exactly.
Maybe the Society of Professional CFA could take the lead in educating the public more.
Yeah.
Thank you for being on the program.
Bernard, thank you very much for the opportunity.
We've been talking to Nana Yafibuama, who is the president of the CFA Professional Society, or Professional Chartered Finance People, and he's been helping us understand the basics of investment. This is not a comprehensive one. We will discuss real estate in our next program. Thank you so much for watching and listening. This program has been brought to you by Absa Bank, MTN, and Zonda Technologies. We'll talk to you next time. Bye-bye.